Sterling has recorded its steepest monthly decline against the dollar since the wake of the Brexit referendum, against a backdrop of intensifying economic and political uncertainty. The pound fell 4.5% in August to $1.16 in the biggest monthly drop since October 2016. It also declined by almost 3% against the euro. It started September of this year, 2022, with a further 0.8% fall against the dollar, although it gained 0.3% against the common currency. The currency's August tumble reflects the deteriorating outlook for Britain's economy as the energy crisis deals a powerful blow to businesses and consumers. The new Prime Minister, set to be named next week, could bring forth uncertainty as they set new fiscal policies, or rather priorities. Cyclical crosswinds are likely to intensify the pound into the autumn as the UK economy navigates new fiscal initiatives against still rising energy costs and consumer price index. According to JP Morgan, this is what they indicated last month. Liz Truss, the current frontrunner to win the Conservative Party leadership contest, has vowed to offer $30 billion in tax cuts as part of a plan to buttress the UK economy against the worsening cost of living crisis. Economists say a loosening of fiscal policy could alleviate the recession that is forecast by the Bank of England and many City of London economists to begin later this year, 2022. Some analysts have said a stimulus of this nature could make it more difficult for the Bank of England to battle the worst bout of inflation in more than 40 years. The chief economist at Investec in London, Philip Shaw, said the sterling's rapid fall was very worrying because it underlined concerns that if Truss was named Prime Minister, her government's policies will diverge from that of the Bank of England. UK debt markets sold off in August, with a broad Bloomberg index tracking government and corporate debt falling more than 6%, much worse than the regional peers, including Germany and France. The sterling sent 10-year government borrowing costs in the gilt market soaring more than 0.9 percentage points, in the biggest rise since at least 1989. In equities, the FTSE 250 index of medium-sized UK listed companies, which are considered more sensitive to the domestic economic outlook than those listed on the more internationally focused FTSE 100, fell 5.5% in August. George Saravelos, global head at FX Research and Deutsche Bank, said investors were right to question whether the UK's mix of fiscal and monetary was appropriate and how it would affect inflation. Pricing pressures are becoming persistent and broader. But what kind of signal is the UK government sending about inflation? Saravelos added that Bank of England had not been as aggressive or effective in its communications about inflation risks, and either the US Federal Reserve or the European Central Bank. Okay, he went on to point out that the reaction of the currency markets to aggressive fiscal promises that were unfunded or a broad-based VAT tax cut were likely to be less favorable than help on energy bills targeted at the relevant income groups. The pound was also pulled lower by a broad rise in the US dollar last month as traders bet that the Fed will pursue a strategy of aggressive rate increases in the coming months. But the pound's fall in August was still more severe than any of the G10 currencies besides Sweden's krona. there are tentative signs that the pressure on the currency could be easing. Speculators, including funds that trade currency derivatives, have cut their bearish bets against sterling in recent weeks. The group now holds a net short position of 27,966 contracts compared with a recent high of 8,037 in compared with 80,370 in late May, according to Commodity Futures Trading Commission data compiled by Bloomberg. Leverage funds are not as aggressively short against the sterling, according to Stephen Gallo, European head of FX strategy at BMO Capital Markets. Other fund managers, asset allocators, are reducing their sterling hedges, which suggests they are trimming their exposure to UK assets. But it is unclear if these recent moves are being driven by short-term portfolio flows or by shifts in long-term foreign direct investment flows. Large international investors cut their exposure to the UK stock market in July of this year, 2022, with a net 15% of global managers reporting an underweight UK equity position, a fall of 11 percentage points compared with the previous month's position, according to Bank of America, which canvassed the views of 250 respondents with combined assets of $752 billion. Okay, so the sterling hit by worst monthly drop since Brexit vote fallout. UK assets slide in August of 2022 on jitters over outlook for the economy and political change. Pound notches up worst month against the dollar since 2016. And UK bond markets hit with heavier August selling than regional peers. So see what you make of all of these things, and I'll continue to update you. Thank you very much for watching this video.